Welcome, everybody. It's Ken McElroy with the Real Estate Strategies podcast, and I am here with my good friend, Tal, my business partner in Limitless, if you guys have been to that. Welcome, Tal.
Thanks for having me, Ken. I thought I was your best friend, but I'll deal with good friend. That's good enough for me.
What's happening right now with single family in your view?
Yeah, it's definitely the single family market for a real estate investor versus a homeowner, meaning like somebody living in the house versus a real estate broker versus a mortgage broker versus even a title agent. Like it's changed. Every one of those individuals has a very different story to tell from their experiences in a nutshell over the last 12 months. And their current experiences vary for sure. I was actually just on the phone. I mean, nobody really thinks about the poor title insurance agent that used to get all their business from the single family market. And now they're like, shoot, all the real estate agents aren't selling anything. The mortgage broker refinance business is down. Like there's a lot of people affected by the single family market professionally, not just as investor wise too, but the people that are standing strong for the most part are the people that bought their house at a very low interest rate or refinanced their house at a very low interest rate. And they're sitting on like 2-3% interest rate loans that they don't have any desire to move out of, right? Because where are they going to go? And even people that are buying a house right now for the first time, there's no competition, or there's a lot, or there's a lack of competition. Sure, they might have a higher interest rate that they're dealing with, but they're not dealing. They're being able to be a bit more picky for what they're buying. So they're able to get concessions. Like we had to do concessions, seller concessions for the first time in freaking, I don't even remember the last time we did seller concessions in Seattle, Washington, which is where most of our houses were. And yet over the last 12 months, anytime we sold something, we're doing seller concessions for the first time ever. So the buyers that are looking to buy a house right now and live in it, even though the prices are still kind of high and the rates are high, they're able to be a little bit more picky and choosy at the same time. So that's a benefit, I guess, right? And then, but as far as us unfortunate real estate investors that are single family, from my experience personally and being involved in the events industry, it's definitely introduced me to a tremendous amount of other real estate investors and the stuff that I do with Bigger Pockets. Everybody's got a different story. It's weird. Some people are like, this is the best ever. But that's only a couple people. And then there's, there's the majority of us that are like, what the heck do I do right now? Right. And the people that are struggling are the ones that have projects still that they didn't get out of. If there are somebody that was a house flipper in 2022 or somebody doing the BRRRR method, buy, rehab, rent, refinance, repeat, the people in those situations are the same, going through the same problems as the multifamily value add investor that didn't get out of their hard money loan or whatever they were using for bridge funding before they stabilized the property, right? They still were in construction, and now all of a sudden their cap rate changed, and all of a sudden they can't get financing, or the rates have changed. That's the multifamily world right now for people that were value add that were stuck in that little bubble. But at the same time, single family house flippers and BRRRR investors that's just bought a project expecting to get a 4% interest rate on their loan on the back end, that now has a 7, 8, 9, 10% interest rate option for single family because it's investor rate. They're stuck. Or all of a sudden that house flipper that thought they'd sell the house at a rising market, that now they're stuck, right? So those people are the ones that are struggling the most right now, like financially. And luckily I listened to you, Ken, believe it or not, last year, where I'm like, bro, like I'm kind of thinking I should do stuff right now, but I'm not really sure. And you're like, sell everything. Like at least let my active projects. You're like, get out of those projects as fast as possible. And he told me before the end of the earlier last year in like April, I believe it was.
Guys, like hopefully you realize that now at that point we were probably 5 or 6 rate increases in. You're about halfway, I suppose. What do you think the loss would be today? So I know you, because nobody talks a lot about writing a check to get out of a deal. I remember you calling me. You did that on a couple of them, I believe. So yeah. What would those losses be today? They were 150 a year ago. What would they have been now?
Yeah, I haven't had enough desire to beat myself up a lot to look that up specifically. But I could tell you, like, right now the holding costs would have been killer, because like one of the deals sold for 1.2 million, right? It's Kirkland, Washington. It went from, when we bought it, the ARV on it was 1.4 million, and then it went up to 1.6, which is what we were planning on. At 1.4, we would have made like 100 grand, 150 grand, something like that. And we've been like, sweet. And then it went to 1.6, and we're like, yeah, we're geniuses. This is why we bought this market. And then it went and sold for 1.2. And that all happened in about a 4.5, 5 month period. Like, and that house, yeah, from when we purchased it to sold it was 5 months exactly. And so that's how volatile that market was at that time. It would have gone down even more as the rates increased. I bet you that same Kirkland house is probably 1.1 right now, something along those lines. It wouldn't have gotten better. It definitely would have gotten worse the longer we waited, because everybody just froze right at that moment. And I'm stuck with hard money and like costs and a lot of expenses.
So let's kind of summarize here. Like the life of a deal, basically you find a deal, you go find a hard money, you do a rehab, perhaps heavy, light, whatever it is, and then you put it right back on the market. But those are typically 3, 4, 5, 6 month type deals, right?
Yeah,
So
it absolutely, absolutely. It all depends, but yeah.
are any of those flippers in trouble right now?
Yes. And actually, most of them, what I would say in reality is that the people that were in trouble the most, they've kind of either gotten out of their trouble already, or they're still going through it and they're underneath a rock right now. And there's definitely people that I know that are out of the business, like completely out of the business. People that were part of our groups that we host and stuff, that really got hit hard. And I remember these, I mean, I'm still talking to these people every now and then, but the writing was kind of on the wall well before the market shifted, because the people that got affected the most were that were full time. Let me specify this: that are full time active businesses were the ones that kept going one more notch higher, setting the bar another notch higher, and getting kind of out of their box every time, doing
Right.
more projects than they're used to, doing, spreading themselves out more and more and more. And the problem with that, which I don't know where I learned it from or when, I stayed away from that for my most of my career, was because I think I heard all these horror stories. Because actually, I was there during the 2008 crash. I was a financial planner back then, and I dabbled in real estate. So I always saw that, and I got to see all the aftermath of what happened to people that were full-time in real estate then. And the ones that got damaged the most were the ones that kept upping the bar every single time as house flippers, where maybe they were doing 3 projects at a time, and then they would take all their money and dump it into 5 projects at a time. And then they would go bigger. They go from a $50,000 remodel to a $200,000 remodel. And so the people that I saw that really lost it were the ones that were constantly pushing those envelopes, but not paying attention to their money. And like I've talked about this before, maybe with you as well, where the biggest issue with most house flippers and reality single family investors in general is not paying attention to their business cash flow. And that's what's most important. So they might be looking at a property net profit, or they might be looking at an NOI on a rental, but they're not looking at their business cash flow. And they don't know what their run rate is. They don't know like how much they can weather a storm. Do they have cash reserves? Most of the people that got really messed up in 2022, are the ones that didn't have a lot of cash reserves, because they kept like either spending their money or reinvesting it all heavy right back into their business, and didn't ever take chips off the table. So
5+ minutes left. I wanted to ask you about Airbnbs. So, there's some talk about, well, we had an Airbnb guy on the channel, and he basically said that there was like 50 to 75% increase in the number of Airbnbs in the last several years, which has created obviously an oversupply. So, and a lot of those, as were with high interest debt. And also they're based on high rents. So do you see that market? What do you see with that market moving forward?
man, you talk about like just seeing a car accident ready to come. Like I saw that thing, like maybe you and I talked. I don't remember if you and I talked about it or not. Like we might have like BS'd about at some point, but man, I saw that car accident so far out. I saw that thing in like 2020, and I'm like, dude, no, I'm never getting to Airbnbs now. Like
Yep.
watching
Yep.
everything, because you got. I mean, if we go back a little bit in history, what 2-3 years ago, um, Airbnbs became super popular because of COVID. And if you went to, like, I traveled a lot during COVID. I don't know if I didn't really, whatever. But I would stay at an Airbnb, because if I went to a hotel, it sucked, right? One, nobody's there. All the restaurants are closed. You have to go through a bunch of stupid stuff. You got to wear your mask everywhere, like all that stuff. You can't have friends with you, right? Like, it sucked, right? And so what did you do? You go to Airbnb, where you could do whatever the hell you wanted to. So Airbnb spiked, right, big time during that time period. They were already getting popular, but they became more popular during that time period. And then you have all these friends of mine and some friends of yours, bragging about how cool their Airbnbs are. And then people get excited about that. They want to make money. And
Yep.
man, when I saw so many people that I know going like, and people that I know don't do real estate going like, I'm getting into Airbnbs, I'm like, I'm never getting an Airbnb.
Time to run.
Like, no. So, and I'm like, and I told them all, I'm like, dude, it's gonna get oversaturated. This is gonna happen. Like, and forget the interest rates, like just a saturation. So, I do have now, needless to say, I have friends that have made a lot of money doing Airbnbs. You can be very successful at it for sure. And I also know a lot of people right now with a lot of empty houses. So for, so yeah, I don't see it really being a good thing. I also don't like I've told every one of my friends that got in that stuff that we're getting into it, and I believe this full heartedly. Like, if you only have one strategy for that property and it only works as an Airbnb, don't buy it. And because you're stuck on so many like things you can't control. If the local regulations change to where you can only do 30-day minimum rents now because of midterm rentals and Airbnbs aren't allowed to have it there goes your entire business model, right? What's your backup? Can you rent it out and at least break even? Like, if it was long-term rent, could you sell it because you got equity in it? Like, what's your strategy if it doesn't cash flow, if you cannot make the Airbnb work? You have to have another one, in my opinion, if you do that. It's also a hospitality business. And I'm not the most hospitable person in the world when it comes to that stuff. So like, it's more of a hospitality business than an investment business. And so it's not passive at all, even unless you really, really outsource everything, then you're giving away huge chunks of your profits. But so yeah, I think it's one of those strategies that if you want to put your mind to it, you can do very well at it. But I think it's not for most people, for sure, especially right now.
I want to know what you think the Fed's going to do here in the near term.
Oh, they're going to drop all the interest rates. Everything's going to go back to normal.
That's what everybody
And
says in your business.
yeah, like what I know I got this from you. Like, we were like the only people that are hopeful, the only people excited about the only people that are still optimistic about the market are house flippers that have properties and people trying to raise money. Right? Like
That's right.
Said that. Yeah.
Yeah.
No, I think that I can tell you what I think and what I hope. I think that, in my opinion, right, that the rates are going to stay very similar to where they are. If anything, maybe they'll creep up more. And I don't think they're dropping them anytime soon.
Yep.
I also hope that they don't. So especially for my investment strategies that I'm deploying now, they're reliant on the rates like not dropping. So I also don't think it's good for the economy if they drop the rates. So that's my biggest thing. Even though, would I love to have all my properties just skyrocket in value again overnight, like they did, between 2021 and 2022? Do I want all that to happen? Like, freak yeah, high five, sell it, make a bunch of money. But I think it's horrible for the U.S. economy if they did that. I think it's more detrimental to us, like as a whole, for sure, if they just all of a sudden dropped the interest rates and went back to what it was a year ago even.
All right, Tara, what's the best way people can reach you?
2 ways now. It used to be only one. So Instagram, of course, I do post a decent amount of stuff on there on a regular basis at Tal Yarber. And then now you can go to talyarber.com. And I have a newsletter now, a text letter that we do weekly that just got started up. You do get my profit and loss spreadsheet when you sign up for it, including a video how to use it. And then you also get my entire video that I did at Limitless, which is the 6 stages of systemizing your real estate investment business, for free when you sign up for my newsletter on talyarber.com.